Hey, hello everyone. Welcome to today's webinar, Advanced Charting Method with Errante's TradingView platform. I'm excited to have you all here, and I believe by the end of today's session, you will have a solid grasp on how to use a variety of chart types effectively in your trading strategies. Before we dive into the details, let me briefly explain why we are focusing on chart types today. As traders, especially in volatile markets like Forex, we rely on chart patterns and visual presentations of price data to make informed decisions. But with so many different chart types available right now, ranging from candlestick charts to more advanced tools like Heikin-Ashi or Renko charts, understanding their unique logic and knowing when to apply it can be somehow overwhelming. So our objective for today is to simplify this for you. I will walk you through the most commonly used chart types, especially as Errante integrated trading view platform. So now we have access to much more tools, charting tools. So uh, more importantly, I will explain the logic behind each chart, why they are designed the way they are, and the most practical purposes of each chart type, which means when and why you would choose one over another. And of course, how to use them to define market direction and identify potential reversals is the core of our discussion today. This session is about practical, actionable insights. So whether you are a day trader looking for quick momentum signals or a longer term swing trader seeking trend confirmations, you will learn how to apply the right chart type for your specific needs. But before we begin, please confirm for me if you can hear me clearly and can see my presentation properly. That would be a great comfort to continue this session. Thank you for your cooperation. Okay, great. Thank you so much for confirmation. Okay, so I see almost everyone has sent the confirmation that they have good visuals. Okay, that's cool. So all okay from your end, and let's continue without any further ado. Uh, please notice that this webinar is brought to you by Errante. And before we begin, please note that the contents of this webinar should not be construed as investment advice of any type. The strategies and information provided are for educational purposes only and should not be considered as any kind of recommendation to trade, because you know trading CFDs carries a high level of risk and it's possible to lose all your invested capital. So please ensure you understand the risks involved and seek independent advice if necessary. So here's a quick roadmap of what we'll cover in this session. First, I will start with the basic chart types such as candlesticks, bars, and volume candles, discussing the logic and when they are most useful. Then we will dive into line and area charts. I'm pretty sure that most of you are familiar already with these types. However, we're going to just shed a light to these simple yet powerful tools for trend analysis, and we will follow that with volume-based charting techniques, which is somehow new to many traders as it's an exclusive charting, let's say, tools only on TradingView. So uh, we're going to focus on understanding market participation through tools like the volume, footprint, and TPO charting methods, which is somehow, let's say, there's a lot of debates around the volume in Forex, and we will get to that as well. And finally, we will explore how to apply these charts and to incorporate them into your trading strategies step by step in a very practical way. Now, we thought, before that, please keep in mind that we have interactive Q&A sessions. So uh, if you have any question, just write it down to me through the chat box, and I will be more than happy to answer you if I know. So don't hesitate to ask your questions, please. Now, without further delay, let's jump right into the different chart types, starting with the basics. Let's start by answering a key question first. Why should we even care about chart types? Here you see on my slide there are many different types of charts. However, after all, some traders may say price action is price action, right? Well, I will demonstrate to you that it's not true exactly, because the way we visualize market data has a significant impact on how we interpret trends and make decisions. Some charts are great for spotting, let's say, clear trends and momentum, while others excel in eliminating noise and helping us focus on the bigger picture. So some charts, like candlesticks, give us a lot of detail about price action within a specific time frame, focusing mostly on market psychology, while others like Renko or point and figure charts filter out less important fluctuations and help us zero in on most meaningful moves. So choosing the right chart type can give you a strategic advantage, especially when it comes to defining market direction and anticipating reversals, which is the core goal of technical analysis and charting methods, to spot reversals as soon as possible on the chart. And that's the only purpose of using all of these tools. We are not going to make it complicated for us purposelessly, but we are going to just use the right tools to, let's say, identify or recognize reversals as soon as they emerge in the market. So by the end of this webinar, you will have a good understanding of when and why to use each charting method. So let's begin with the basic chart types, which are the foundation of how we interpret price action. These chart types are popular because they provide an intuitive and detailed visual presentation of the market. Understanding these basics is crucial because even though they are simple, they can tell us a lot about the underlying behavior of the market. We will start with one of the most widely used tools in technical analysis, which is the candlestick chart. Let me just move to TradingView that would give us the better visualization on the real, let's say, market data. Okay, here you go. You can see my screen, I guess. Let me recheck again to make sure that everyone can see. Okay, that's great. Okay, perfect. So yeah, you can see here, we actually reviewed in our previous webinars about how to log into Errante on TradingView platform. Okay, so I'm gonna just skip that for the moment right now, and let's get to candlestick chart. You see here we have some very important panels on the TradingView platform. First of all, on the left side we have this uh, visualization or let's say drawing tools, and on the upside, the right corner, you see we have on the left corner, excuse me, you see we have the list of different chart types that we can apply on the price data. And one of the most common used type of these is candlestick charts. So you can easily just move through different chart types by clicking on each, and we will get through that very soon. So candlestick charts are one of the most widely used tools in technical analysis, and there is a good reason for that, because they are not only provide a detailed view of price movements, but also allow us to interpret market psychology. This is a point that make it very, let's say, exclusive, because the collective sentiment of buyers and sellers at any given point in time can be interpreted on candlestick charts easily in a very, very great and clear visualization. So each candlestick represents a specific time period, whether it's a 1 minute, 5 minute, or daily candle. And on TradingView charting tools, you have also access on 1 second time frame if you use the let's say uh, a pro version of TradingView, by the way. And you can get access to the wide range of time frames even on basic or let's say plus version of the TradingView. And right here I am using the 1 minute, for example. You see it means each candle is constructed just in 1 minute. So the anatomy of each candlestick consists of 4 key pieces of information, which is very important for us to interpret the psychology of the market. First, the open price, then the high price, the low price, and finally the close price. So we call it the OHLC, or the 4 different prices. First, we have the body of each candle and also the shadows. The body of the candlestick tells us whether the market closed higher or lower than it opened, because it shows the distance between the opening price and the closing price. And the closing price somehow on a current candlestick is the current market price. So a green, or as you see here, a blue one, shows that the market closed higher than it opened, indicating the buyers are controlled during the period, while a red uh, or black candle somehow means, but here we have it in red, means the market closed lower, reflecting selling pressure. But candlesticks go beyond just price data. They help us gauge market psychology. But how? A long green candle shows a strong buying pressure. So if you're looking for a very high momentum period in the market, you need to find those candles with a very long bodies. Okay, for example, something like this long red candlestick here, and which is representing a very let's say significant selling pressure in the market. And also these blue candles here, as I said, uh, it shows a strong buying pressure and optimism into market, meaning buyers dominated the session. And this is how actually this is where candlesticks excel compared to other chart types, because they give us insight into who is winning the battle between buyers and sellers in each defined time frame. So uh, now let's talk about the shadows or wicks, which represents the highest and lowest prices reached during the period. And they usually they are usually drawn from the, let's say, the body for the highest or lowest prices in the market. And they tell us a lot of information about the market volatility, which is one of the most important thing to gauge the sustained momentum in the market. If you want to make sure it's going to go in the same direction, or there is any sign of changing the trend, maybe out of the sudden. So the upper shadow The upper shadow shows the highest point the price reached, while the lower shadow indicates the lowest price. The length of the shadows is crucial for interpreting tops and bottoms in the market. Uh, and how we are going to define tops and bottoms: long upper shadows show that the price tried to go higher but was pushed back by sellers, which can signal a potential top if this happens in an uptrend. And long lower shadows show that the price dropped but was pushed back pushed back up by buyers, which can indicate a bottom in a downtrend. For example, a candle with a long lower shadow, as you see, uh, for example, here at the end of this, let's say, declining period, or the, let's say, downswing in the market. And a small body near the top is often seen as a bullish signal, like the hammer pattern. Actually, we have had a very thorough webinar about candlestick patterns, and I would like to address you to that webinar. You can find it on our website, errante.com, in webinar section. And I really recommend you, if you are not familiar with these patterns, because we don't have such much time here to discuss all the details about the candlestick patterns, but you can refer to that webinar as well to get more familiar with all of those advanced patterns. And one of the most reliable one that we discussed there is the hammer pattern, which suggests buyers are starting to gain control. And it usually comes with a very long lower shadow, two uh, or three times longer than the body. Okay? The body on the top with a very, let's say, small or no shadow on top. So that's the construction of a hammer pattern. Conversely, a long upper shadow is in an uptrend may indicate exhaustion from buyers and a possible reversal, as we see in pattern like the shooting star. And let me find a good example for you here. For example, here we have a doji, but the better example for that can be found somewhere like this. Yeah, for example, here you can see here something like a, let's say, the long leg doji, which means we have a candlestick on the top, or on the top of a upswing, let's say, which is representing the market top, and it usually comes with a red candle following the indecision candle that represents the market decline. And here you can see we have a very a bit long upper shadow and a very small body. We usually call it something like a doji, and also we can find some examples like this with a different shape of body that we call it shooting star, and that usually happens when we don't have a lower shadow, or it's a very, very small, and we also have a very long upper shadow, 2 to 3 times longer than the body. So you see, the length of shadows as well as the length of bodies have a very clear, certain meaning to define the market psychology. So certain candlestick patterns are specific, especially good to identifying these potential turning points. Now let's discuss how to define tops and bottoms in the market using candlestick patterns, which is the most important part of trading, because if you want to identify trend direction, or you want to identify trend momentum, and also if you want to identify trend reversal, in all cases you need to, let's say, spot tops and bottoms correctly. So first, you need look for patterns like the shooting star, which has a long upper shadow and a small body, showing that buyers push the price higher but fail to maintain those levels, indicating a potential reversal to the downside. Doesn't matter what you call it. The different books, they usually introduce you a lot of different patterns with very different names. Some of them so exotic. So don't bother yourself with those names. Okay, just keep just remember. Try to keep in mind the psychology behind that. We need a very nice, clear upward movement, and at the end of this, we need to see the following candles can reach the top of the let's say uh, this let's say top candlestick high price. So that's the very clear sign of changing of market psychology in any kind. So or when you see a very long upper shadow instead of a long blue body, that's another interpretation of the let's say the trend, the upward movement is getting out of steam somehow. So, and also we have the same application for bottoms. Patterns like the hammer, like engulfing or key here, where a long lower shadow shows the sellers push the price down, but buyers stepped in and drove it back up, signaling a potential reversal to the upside. So the main reason of using candlestick patterns is market psychology. Okay. Now, next, let's move to the next one because I really don't want to miss any of these chart types. We will get through the more details maybe in our next webinars. Next up, we have the bar charts. Also less commonly used today compared to candlesticks. Bar charts are still favored by many traders, especially in the West and the US and in North America, especially those who prefer a cleaner, less cluttered view of price action. Bar charts display the same key information as candlesticks. They actually consist of four prices: open, high, low, and close price, but in a more compact format. Instead of using a body like candlesticks, bar charts use a vertical line to show the price range for the period, with small horizontal lines on either side to indicate the opening. You see here this is a left handle and this is a small handle on the left, and closing price, the small handle on the right side. And also they shows the market range with this vertical long bar here. Let's go to TradingView again. Yeah, here you can see choose bars. It's very simple actually, and you can see the visualization of price data through bar charts. In bar charts, colors are often used to distinguish between up bars and down bars. Okay, similar to how green and red candles are used in candlestick charts. You see here we have some green bars. Green bars indicate that the closing price was higher than the opening price, signaling bullish sentiment for the period. And in some books, or let's say in some older charting methods, we somehow distinguish bullish bars when the closing price of the current bar is higher than the closing price of the previous bar. So it depends on the method you use, but you have the choice to change in the setting. You have the choice to go to, I guess, a status line somehow. And here you can actually change, sorry, in symbol area, you can just change the as a data modification. And here you see the bars. You can just take on this as a color bars based on previous close, or no, just a regular candlestick chart, which is more common, but doesn't matter. We will get to some details later that can make difference for us. However, let's get to red bars. Those mean that the closing price was lower than the opening price. For example, you see here the last bar here, we have the closing price lower than the previous one and also than the current open price. So we see this bar in red. Okay, so how we can define market direction and key reversals using bar charts, which is very important. Just like candlestick charts, bar charts are useful for identifying market direction by looking at the series of bars. If the bars are making higher highs and higher lows, it typically indicates an uptrend. Conversely, lower highs and lower lows are a sign of a downtrend. For example, you see here, when we have these red bars in order, which all lower, higher, high, and lower, lower, low, so we can define these patterns, let's say, as a downtrend. And on the opposite side, you have, for example, this series of bullish bars here, all with a closing price higher than the previous one, and also the higher high and the higher low. So we can, let's say, identify it as the as an uptrend. And why we are saying that? Because if you move to lower time frame, you see these are respectively ordered bars here. All of these highs and lows somehow represent market tops and bottoms, as we discussed, in lower time frames. So in that case, we're not going to bother ourselves by moving, make things complicated, moving through different time frames for now, just for now, yeah. And so we can use, let's say, this definition for of higher highs and lower highs to define the market direction somehow. So you see, we are in a downtrend, an uptrend, and we have this also in theory. More books are saying that an uptrend is a series of higher tops and higher bottoms, and also a downtrend is a series of lower tops and lower bottoms. So it gives us a better understanding of this by make it a bit simple, yeah, more, let's say, simpler than the candlestick chart. So uh, here are two types of very specific bars I would like to mention, which I think can be very helpful for you, and it's very somehow exciting. First, a divergent bar, which occurs when the price opens and closes in opposite direction during a period of increased volatility. In other words, if the market, for example, has been moving in one direction, let's say upward, and you see a divergent bar with a higher high but a lower close, it signals a reversal or a potential slowdown in the trend. For example, let's walk through the price charts here to see if you can define something. Sure. You see on this 5-minute chart here, for example, after the series of these green bars, we have this red bar with the lower closing price but the higher high. So uh, we can define it as a bearish divergent bar, and we have the same just in the opposite direction when we have a series of bearish, let's say, bars, but uh, they usually ended up with a bar which has a higher closing price but a lower low. So that's a bullish divergent bar. And these are, for many years, these are a very clear sign of market reversal. So this formation suggests that although the price attempted to continue in the direction of the trend, as seen by the higher highs, for example, it couldn't sustain the momentum, leading to a close in the opposite direction. So this is a strong reversal signal, particularly when it happens at the top or bottom of a trend. So when you can, for example, combine it with your, or incorporate it with your, let's say, trends momentum and market tops and market bottoms. So in that case, that would be a very clear sign of market or price reversal. So the another important, let's say, uh, very special bar we know is a pin bar. For many years, you see, we have some kind of trading strategy named uh, uh, let's say UK pin bar. Yeah, at the beginning of the London session, it's the London pin bar, something like that. And this is another powerful reversal signal in bar charts, uh, which is similar to the hammer shooting star patterns in candlestick charts. You know, the candlestick charts, uh, it it has been rooted in somehow traditional Japanese uh, financial analysis or something, but we know the bar chart is coming from Western market analysis or technical analysis. But somehow you see they have a very similar, uh, let's say, definition for exhaustion uh, at the end of a, let's say, uptrend or downtrend. And one of them is a pin bar. Pin bar is just it's just representing hammer or shooting a star patterns in candlestick charts. So a pin bar has a small body and very long shadow or wick on one side, showing us that price was rejected at one extreme, either high or low during that period. So the shadow shows where, let's say, price attempted to go but failed, and the small body indicates that the market closed near the open. And we can have let's say have a bullish pin bar and a bearish pin bar. A bullish pin bar is a long lower shadow and a small body near the top. uh, this shows that sellers pushed the price down, but buyers regained control and drove the price back up, and it's a strong signal of a bottom reversal. And also we have a bearish pin bar as a long upper shadow. I would be more than happy to find a live example here in the chart that would be much more helpful to visualize what we're talking about. For example, let's say something like this, maybe. Yep. Uh, Here you can see we have a very long upper somehow shadow, and we have both right and left handles as an opening and closing prices so near to bottom. So a bearish pin bar, we can identify it as a bearish pin bar, which has a long upper shadow with a small body near the bottom. And in this case, buyers push the price higher, but sellers took control and pushed it back down, so signaling a top reversal. And these pin bars work best when they appear at key support or resistance levels, further strengthening their signals for a potential market reversal. So in summary, bar charts give us a minimalist yet powerful view of price action. So by focusing on the open, high, low, and close data, we can define trends and spot potential reversals with patterns like the uh, divergent bar and pin bar. Next, I'm not gonna let's see what we have in the store. The next one is a hollow candle. It's very similar to the let's say the regular candlestick pattern. So we're not gonna discuss that maybe, but let's focus on something which is very important in forex trading as well as stock trading. If you are a fan of trading stocks, maybe, or even let's say shares, yeah, uh, we need to shed light on volume candles. First, let me just distinguish the volume and understand the volume in forex and the stock market to make it, a bit clearer for all of us. In the stock market, volume is a key metric because it represents the total number of shares that have been traded during a given period of time. Okay, this information is directly available from exchanges like the NYSE. You can go on the Nasdaq website. You can see all the companies listed in the under Nasdaq market. You can find them, and you can find the real-time number of shares that traded in each session, and uh, so on. So where every trade is recorded and volume is accurately measured in a stock market. Okay, high volume in stock typically indicates significant market participation and can confirm whether price movements are supported by institutional activity or are merely speculative. This is what you see on many, let's say, um, let's say textbooks. Yeah, for example, the technical analysis uh, by John Murphy, which is a holy grail of technical analysis lectures and textbook for anyone who wants to learn about technical analysis. You see, one of the most important tools to confirm price patterns is volume, but that's the case for a stock market. However, in the forex market, things are a little different. The forex market is decentralized, meaning there isn't a single exchange where all trades are recorded. As a result, we don't have access to total market volume the same way we do with the stocks. Instead, the volume available in Forex is often tick volume, which measures how many times price changes during a period rather than how many actual contracts were traded. It means we are seeing a representation of number of let's say tick volume or uh, price changes. But the big question here is volume still useful in Forex? What do you think? Are you a fan of volume indicators in Forex? Because you see they have a different section in MetaTrader 4, 5, and even here in TradingView, there is a section of indicators called volume indicators. And many people are doubting if it's applicable for, let's say, Forex trading. But my answer to this question is absolutely. Although volume in Forex is not as transparent as in stocks, it's still incredibly useful. Why? We don't have access to exact trading volumes across the entire market. Tick volume is a reliable proxy for market participation. Why not? If we can find another, let's say, another piece of confirmation why we shouldn't use that, because studies have shown a strong correlation between tick volume and actual traded volume in forex trading. So here is why it's important. High tick volume during significant price movements indicates a strong market participation and can confirm the validity of trends. And conversely, if you see a major price move on a low tick volume, it could be a sign that the move somehow lacks strength and a reversal may be more likely. And volume-based charts we have, even in Forex, can help traders spot key price levels. And let's get through some of these different charts to see how we can, let's say, interpret them and read them. Let me bring up my trading view again here. Okay, you see, we have the volume candles. Okay, let's talk about volume candles, an incredibly powerful tool that combines price action with market participation. In traditional candlestick charts, you saw all candles are treated equally in terms of time, but with volume candles, each candle's size is adjusted based on the volume traded during the period. So, if a candle is significantly larger, it means there was heavy volume during that time. For example, you can see here, this is a very large, fat, bullish candle. You see here, just near to the uh, end of the market session. Yeah, that's really interesting. So it can be a strong indicator of institutional participation or major market activity. Conversely, smaller candlesticks like what you see here, for example, the last candle of the last 5 minutes of the last session last night, well, you see, this is this indicates low volume, which might mean indecision or a lack of interest from market participants. So why are volume candles useful? Because they help us confirm the validity of price moves. If we see a large green volume candle, it means that the price is not just moving up, but it's doing so with a strong market participation, which adds credibility to the trend. On the flip side, a reversal accompanied by high volume can signal a stronger shift, let's say, in market sentiment. So, uh, how to spot market direction and reversals? First, look for trends in large candles. For example, what you see here, or even here at the last minutes of the US session, we saw. And if we move forward, for example, get to the latest candles in real time, which is going by the first hour of US session right now. Here you see we have them in a very different, let's say, shape. So first, look for trend in large candles. If you are in an uptrend and you see a series of increasingly large volume candles, it confirms the strength of the trend. However, if volume starts to fade or you see a large volume red candle after an uptrend, could indicate a reversal is on the horizon. But please don't trade this solely, because you need further confirmation to combined with these volume candles to make sure if the reversal is emerging there. However, you can see, for example, after this large red body candle, we have this very thin bullish candles following them in terms of at least they are interrupting, yeah, the bearish momentum in the market at this significant support level here. So we can consider any reversal at the point of uh, hitting this resistance level on the top here, and we see it's followed by the price action for later in the session. And this is a way that we can use these volume candles to confirm or to get a warning about the trend reversal somehow. Now that we've explored some of the more detailed chart types like candlesticks and volume candles, let's shift to something simpler but equally powerful: line and area charts. These chart types focus on the bigger picture and help traders stay focused on the overall trend without getting distracted by the noise of smaller price fluctuations. Sometimes simplicity is all you need to make sound trading decisions, especially when you're looking to identify long-term trends or filter out intraday volatility. Let's dive into how these charts work and when to use them. Could be actually the last discussion for our webinar today, maybe. First, let's talk about line charts. You see, you can choose line chart from the list here very easily, and now this is what you get. And let me just change it to maybe daily chart. Why not? Okay, line charts are the most basic type of price chart, but one of the most effective when it comes to trend identification. Anyone who sees this trend, this line chart, can tell me what is the trend in the market, or at least you can get a sense about the market. Yeah, you can compare this market bottom here with this market top here, and you can say, oh my god, there's something happening that pushes prices higher in the market, so it can be an uptrend, because in that case the identifying the tops and bottoms is much easier, yeah, because we filtered all the noise from our visualization. So line charts plot only the closing price for each time period, connecting those prices with a continuous line. That's the secret of this simplicity. And they completely ignore the open, high, and low prices. No noise, okay, which may seem like a drawback, but this simplicity is actually uh, what makes line charts so useful in certain situations, especially if you want to look at the very long-term data. In that case, you will be able to just look at the closing prices and to see this the sense of market direction and the results, let's say, and the conclusion of all the magic behind the market, like market psychology, buyers, sellers, shadows, let's say. If you just leave back all of those, you can get a very simple picture of the market. So why use line charts? That would be a good question. Line charts are great when you want to filter out market noise, as I said, and just focus on the bigger picture. For example, if you are trying to identify a long-term trend in daily or weekly chart, the closing prices often provide a clearer signal than looking at every little price movement. So they are also a favorite for visualizing support and resistance levels, because in that case you can just uh, draw a line here at each market top or each market bottom, and you can see it gives you a very, very nice visualization of all support and resistance levels. So how to spot market direction and reversals? Look for consistent higher highs and higher lows in the line for an uptrend. You see, the basics are solid. We are not going to change the theory, but we are going to use the different tools to spot that theory, to prove the theory, or to let's say to get confidence about spotting the theory on the chart on the real-time market. So look for consistent higher highs and higher lows in the line for an uptrend, and lower highs and lower lows for a downtrend. As you see here, for example, we have a higher highs and higher bottoms, so it's defined as a very beautiful uptrend. And vice versa, we have on the other side, for example, here the lower tops and lower bottoms, which is a downtrend. And that's it. So if the line starts to flatten out or change direction, it could signal a reversal, like what happened here, you see, or what happened here. So you can easily spot reversal using these line charts. And similar to line charts, step line charts plot the closing price. The next one is the step line. You can find it here. See, it's a bit different than the traditional line chart, but don't worry. We're gonna explain it. They do so in a stepped manner. That's it. This is all still closing prices, and it gives more emphasize on the periods where price remains unchanged before it moves again. So this is particularly useful when you want to track sideways movements or when the market is consolidating. So the step-like formation helps you visually identify when price breaks out of consolidation or remains range bound for an extended period. And reversals can be identified when the let's say steps start trending in the opposite direction after a breakout, indicating a change in market sentiment. For example, you see here, when we have this step here, it means the market has been consolidating for a couple of periods, and then we have a change in market momentum, so we have this step down. So this is a better visualization to identify the market ranges and also to identify maybe price reversals. And next up we have area chart. Let's get to the list, and you see here the area chart is very let's say area chart are ideal for traders who want to focus on the direction and the strength of price moves. And why we have this in TradingView? Because under this section here you can choose you can get to calendar, and in this calendar you can apply or launch a chart of each market data. And in that case, to get to a very long period, you don't need to, let's say, use a candlestick or something, which would be very complicated and very hard to, let's say, interpret. But here you can just easily use something like an area chart to get a better visualization about the changes. For example, here we have the United States interest rate on a daily basis. Yeah, so that case you are with this area chart, or you can change to a step line chart, and that case you can get a better. For example, you can see here the period of time from the July 2023 till August 2024 that the rates were unchanged. So you see, this is a very, very simple way to identify the trend, even for market events, even for those, let's say, those macroeconomic indexes. So, and also they are especially useful when you want to see the time elements of price changes, as the fields area gives a sense of duration and the strength of the trend, as you see here. But let me just change to another trading instrument like Euro USD, which be, or GBP USD as we were looking at. So how to spot market direction and reversal? Area charts make it easy to see trend shifts by observing the slope of the area. A consistently rising area indicates a bullish market, while a, a falling area shows bearish pressure. So if the slope flattens, uh, it could indicate the market is losing momentum and a reversal may be coming. So let's see what we have next. This is it's getting more complicated, yeah? But don't worry, I'm gonna explain it to you in a very simple way. Now that we've covered traditional price-based charts, it's time to explore a crucial but often underutilized element of market analysis, especially in forex trading, which is volume. Volume can be, let's say, can be thought of as the fuel behind price movements. It represents how many participants are actively trading during a given period, providing a clearer picture of the market's strength and conviction behind price movements. Volume is especially important because it helps us differentiate between valid price moves and false signals. Uh, what do I mean by that? Okay, let me put it this way. A price movement with high volume shows a strong participation and greater reliability, while a price move with low volume might suggest indecision or a potential reversal in the market. So in this section, we'll look at three powerful volume-based chart types that we have on TradingView, and fortunately, you can trade them with Errante. The volume footprint, the time price opportunity or TPO charts, and session volume profile, which is I can say each of these tools offers a unique way to analyze market participation, engage the strength or weakness of trends, and let's say reversals. Now let's start with the volume footprint chart. This tool gives us a detailed look at market participation by showing us the volume traded at each price level within a given time period. Uh, I mentioned before, it's not exactly the because of the decentralized nature of forex market. It's not exactly the number of or the units of each contract traded, but it can give us still uh, let's say imagination of many of how many tick prices just traded between the server, broker, and trader. So this is something that we can somehow extract some good information of that. Okay, let's find it here. You see down the list here, we have the volume footprint. And let's give it some time to appear on our chart area. And now here is what we see. And let me change to a maybe lower time frame. That would be more information to reveal. And here we go. So let me make sure that everyone can see. Yes. Please confirm to me if you can see my TradingView charts on your screen as well. Okay, great. Thank you so much. So unlike a regular candlestick or bar chart, which only shows us where a price has been, the volume footprint chart tells us where the volume has occurred. That is where traders are placing their trades and showing interest, especially with these price ticks. Yeah, so why is the volume footprint important? The volume footprint helps us identify key price levels that are significant to both buyers and sellers. When large volumes are traded at certain price levels, these areas often act as support or resistance zones sooner or later. And price is likely to bounce off these levels, or if the volume continues to build at these points, price may break through and form a new trend. For example, if a price level shows significant volume in the footprint chart, you see here, this is a construction of this chart. They have the candlestick pattern. At the same time, we have the number of tick prices traded. So if a price level shows significant volume on the footprint chart, but the market fails to break through, this suggests a strong resistance. This is how we can identify resistances here. For example, you see around this area, we have some attempts from market participants to break through this level. We can identify this as a strong resistance level, and eventually we see increasing volume contributed to rising prices, so that results in a break above this resistance level. This is a trade opportunity somehow. So this is the first use of it. So if price breaks through a high volume area, that same level often becomes support, as traders who missed out on the initial move may enter at that price again. This is what we see here after breaking this. Just a tick higher became a significant level here with the most let's say tick prices there, and then we see a move to the upside. And to spot reversals, focus on changes in volume patterns. In an uptrend, if you see a surge in volume at a high price level, but the price fails to move higher, it could signal a potential top and a reversal. For example, you see here we have uh, we see some attempts toward this level 1.30724, but eventually we see the market couldn't conquer this uh, let's say level again, and then we have this downward or bearish candlesticks followed by a higher volume on the bottom, on the downside. So this is a way we can spot reversals with volume footprint. Similarly, in a downtrend, if there is a significant volume buildup at a lower price, but the market holds that level and buyers start stepping in, it could indicate a bottom of the market. So in short, the volume footprint helps us understand where major market participants are trading. You see here, this is a volume footprint chart, okay, and it provides an in-depth look at the volume of trades at each price level during a specific time period and GBP USD 30-minute time frame, okay. But let's see what you are seeing here. We have two columns. First, bid and ask volumes, okay. On the left side in red, you see we have the bid volume, which represents the number of contracts or volume traded as at the bid, actually at the bid price. And on the right side in green, you have the ask volume, which represents the number of contracts traded at the uh, ask price. So each number at a specific price level shows how much volume occurred at that price. For example, at the 336 mark in red, let us just go through one of these. Yeah, this is a 30-minute chart, and yeah, let's say for example this one. Okay. Yeah. Yeah, I was saying, for example, at the 336 mark in red, this means 336 contracts or price tick were traded at the bid price, at that specific price level. Okay, and now you see just beneath these columns, we have two, let's say, metrics, delta and total. At the bottom of the chart, you see the term delta here, which represents the difference between the ask volume and the bid volume. The delta shows whether there were more aggressive buyers or sellers at the specific price level. And in this case, the delta is 120 minus 122. You see, meaning that there were 100, and it's changing 100, let's say, uh, 42 or something like that, which is it's this number more sell market orders, aggressive selling than buying orders, indicating that sellers were more dominant during this period. And we see this is a bearish candle to the downside. So we can understand how where the market is going. So you see, we have some deltas in positive numbers and some in negative numbers. Positive delta indicates more aggressive buying, whereas negative delta indicates more aggressive selling. And we have also the total at the bottom. You see, for example, here for this candle, 3.898K. And what does it mean? It shows the total number of contracts traded during this session in thousands. Making K represents 1,000. So this includes both bid and ask volumes across all price levels. Let's see how we should interpret uh, these specific price levels. This means there was significant selling pressure when we see, for example, a bid volume of 300, for example, here 421, for example. Yeah, this means there was significant selling pressure at this price level as 421 contracts were traded at the bid price, and this could indicate the sellers are strong at this level, potentially acting as resistance. And you see, we have this very long upper shadow afterward. And this is a sign of maybe further bearish momentum in the market. And then we have a high ask volume, for example, 365, yeah, at a different price level. Or let's say, look at the different price level. For example, somewhere here, the uh, where we have a more ask prices, somewhere like this, 492. Yeah. So similarly, there was high buying pressure at this level, showing buyers stepped in to observe the selling, and this could suggest support. But it can get more complicated than that, because again, it's not the let's say pure number of shares or contracts traded, is just the tick prices, and it's the tick prices coming from the broker server. So among different brokers it's going to be different. So it means you are not going to get access to the all tick prices of the whole market, because it's impossible. It's because we are trading in a decentralized market. However, we can get a sense of what is going on in your maybe broker. So you can use this. Other levels with a smaller bid and ask volume, for example, you see here on the top or at the bottom of these shadows, are likely reflecting lower levels of interest or trading activity at those prices. That's the reason we see the shadows, because eventually the market wasn't couldn't succeed to close prices at that high or close a price at this bottom. So it means there were some rejection to the opposite direction, and that's the imbalance between the bid and ask volume at each level helps traders gauge the market sentiment. And this is another way we can confirm the uh, a representation of psychology getting from candlestick charts. So if there is consistently more volume on the ask side, it suggests aggressive buyers indicating bullish sentiment. On the other hand, more volume on the bid side would suggest bearish sentiment as sellers are more aggressive. So another great advantage of this chart type is price level and key zones. I'll look for levels where there is concentrated volume on one side, like bid or ask, as these zones often act as support and resistance levels. We got through that before, and you see, for example, here at the and near to this market top here, when the market is going to form a new downtrend, you see we have the most traded tick prices at this level, which we can somehow address it as a significant uh, market top. Yeah, this is an area of resistance. So you see, There was, for example, significant selling pressure, which likely acted as a strong resistance zone. And the sellers were most active at this level as well on the bid side, which might indicate resistance. So overall, buyers were less aggressive, or let's say the sellers were more aggressive than buyers, as seen by this negative delta here, suggesting a slightly uh, bearish sentiment during this session. And increasing number of total volume means the market is very serious getting the price down. So this volume footprint chart helps traders pinpoint specific price levels where market participants were most active, which can aid in understanding further price movements, trend strength, and also potential reversals. So I'm running out of time, so let me get to just one more chart type. Now let's move on the time price opportunity TPO chart, which is very interesting, also known as the market profile. And this is a unique tool, and you might have seen many some traders, institutions, they are claiming that just leave these traditional technical analysis, which is nonsense for many, let's say, professional traders. And now they usually show something like this. If you saw, this is a TPO chart to make better understanding of market volume, and that's the case to spot the let's say resistance support zones. And they usually go to sell it on a very, let's say, high price by making this very complicated. But here we are going to simplify it. So you see, yeah, it might be a bit, it might uh, look a bit complicated. What is really simple? The TPO chart builds a profile of the market by showing us where price spends most of its time. That's it. Okay, so the longer price stays at a particular level, the more balanced the market is at that level. For example, here you see this is the longest period of time that the market stayed at this price level, as we know it as a POC. Yeah. Uh, But let me just break it down to all of these uh, characteristics and to see how it works. The key components, and explain how to interpret these charts. For example, you see here we have a TPO blocks and letters, yeah, and each letter represents a specific time period, typically 30 minutes here, because this is on a 30-minute chart. And each one corresponds to a price level that was traded during that time frame. Uh, in the chart, here on my screen, you can see letters like A, B, C, etc., and each corresponding to a 30-minute time block. These letters stack up vertically, showing the price levels traded during each period. For example, if the letter B appears next to 1.30600, as you see here, somehow, yep, can find it on my chart, yeah. And when you see it here, that means price traded at this level during the B time period, or during the second 30-minute block of the session. And then you see it has been also traded during the C, D, M, N, O, P, Q, and so on. So this is the first thing. And now we have the POC, as you see here, just at the left side of this black column, you see the letters of POC. The POC, black horizontal block, stands for the point of control, which is the price level where the market spends the most time during this session. So like let's say, the block we had uh, in volume footprint that was in black, the most traded tick price. And here we have also the highest level in black. So it means it shows where the market spent the most time during this session. So it's the price where buyers and sellers found the most agreements, resulting in a high volume of trades. So in this chart, the POC is around 1.30550 something, indicating that this price level acted as a key area of equilibrium where both buyers and sellers actively traded. And then we have the VAH on the upside and the VAL on the downside. Uh, let's explain this. These are the upper and lower boundaries of the value area. This is the range where 70% of the trading activity took place during this session. So the VAH is located at the upper boundary of this area, and the VAL, which representing the value area low, is located at the lower boundary. So in this chart. So we have, for example, VAH at around 1.3068, as you see, and we have a VAL near 1.3040. So these levels help traders identify areas of support and resistance as price tends to consolidate into value area, but may also break out or reverse near the VAH or VAL, depends on the market momentum at the time. So then we have the profile shape distribution. Let's say chart you see here in blue colors. Okay, so this is the TPO chart creating distribution profile, which shows the concentration of trades at different price levels. The more letters or TPOs stacks up at a price level, the more time price spent there, and the more balanced the market was at that level. We can also take a look at this on let's say our TradingView platform. Here I have a time price opportunity or TPO. We need to give it some time to appear in the chart, and then here you go. So we have it here, and you see each let's say a POC or a TPO block actually of letters, usually followed by a distribution chart like this. So let's talk about this distribution in more detail, because it's really interesting, because the TPO chart creates a distribution profile. As I said, we have a D-shaped profile. The profile in this chart, for example, here you see, it looks somewhat like a D shape, something like this. Yeah, this is a much better visualization of that. And the profile, you see, it's like a D shape, which indicates a balanced market. And this means that the market spends most of its time in a narrow range with price moving sideways, indicating a state of equilibrium where buyers and sellers are in agreement. In such cases, the market is neither strongly trending up nor down, but rather consolidating within a range. So a breakout above the VAH or below the VAL could lead to new directional move. And then we have a time segment. The letters on the left side of the chart represents different time segments during the day. For example, A could represent the first 30 minutes of the trading session. B could represent the next 30 minutes, and so on. So each letter is stacked to show at what price level the market traded during the time segment. If there are several letters at the same price level, it indicates that the price remained within their range for multiple time periods. And then right side volume profile. On the right hand side of the chart, you can see a volume profile which show a total volume traded at each price level. Then this adds an additional layer of insight by showing where high volume trading took place. Similar to the TPO chart, high volume areas can act as support and resistance levels as well as, and Low volume areas can be indicative of breakout zones where price may move quickly. So by reading the distribution of TPOs, you can get a good sense of where the market has found equilibrium, where there might be potential trading opportunity, especially when the market breaks out of these balance zones. Okay, I think that's enough for today. Thank you all for your attention throughout this webinar. Now, if you have any question, let me just get through the uh, question box to see if we have any. Okay, here's a very nice one. Okay, how do I choose the right volume-based chart for my trading strategy? Great. This is a great question actually, because the choice of a volume-based chart depends on your specific trading style and goals, for example. Uh, let's say volume footprint charts are excellent for short-term traders who need precise price levels where major buying or selling occurred. And this is great for scalping or intraday trading. Then something like the session volume profile or the TPO is more suited to day traders or swing traders who identify key areas of pivot points of the market as a support and resistance based on the volume concentration across sessions. So if you are interested in longer term, let's say, market structure and value, so the TPO is your tool for identifying value area, the point of control, POC, and possible trend reversals. I hope that answers your question. And the next one is, how can I use the point of control or POC in my trading decision? Yeah, as I explained, it's incredibly useful in understanding where most trading volume has occurred, so which reflects the price level that both buyers and sellers find fair value. So here is how we can use it. In a range-bound market, for example, the POC acts as a magnet for price, meaning price often oscillates around the POC. So you can trade the range using the POC as a pivot. And in a trending market, if the price moves away from the POC and volume builds in the new direction, this can confirm the breakout or a new trend. So if price returns to the POC after a breakout, might be a sign of a false breakout or consolidation. So keep an eye on how a price reacts at the POC. If there is a strong rejection at the POC, it might indicate a reversal or potential breakout. And the last question here is that is there a way to combine volume profile with candlestick patterns to enhance my trading strategy? Of course, combining volume profile with candlestick patterns can be very effective. And the idea is to align key volume level, even if it's a tick price, with candlestick reversal or continuation patterns. So if you are very good at let's say identifying candlestick patterns like your reversal patterns, the two candles or three candlestick patterns, uh, like engulfing, or let's say the morning star or something like that, near a high volume node where volume is concentrated, it increases the likelihood of that reversal holding. So the market is signaling that this price level is significant and that buyers or sellers are stepping in aggressively. Similarly, a breakout candle forming near a low volume node could signal that the price will move quickly through this area as there is little resistance. So uh, this combination provides you with confirmation and added confidence in the trade. Okay, everyone, thank you so much for your question. Thank you for your interaction to this webinar. I hope the answers provided you with additional clarity and actionable steps, let's say, to improve your trading. So, okay, that's it for today. Thank you again for your participation, and that brings us to the end of today's webinar. Uh, Thank you each again, and every one of you for your time and attention. I hope you found this session valuable and that you gain actionable insights. I really recommend you to practice all of what we said today on the real chart and to keep going with interpretation and test it to see if you get it right, to combine the volume with the volume based let's say charting method with the other tools and chart types that you have. Okay, thank you so much for being here. I look forward to seeing you in our future sessions. Have a great day and happy trading. Bye.